Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. This week's video is going to focus on the S&P 500, the ASX 200. I've got uranium in there, and I'm also going to look at a copper ETF. All packed into one video this week. Normally I do a couple of videos, spread things out a bit, but I'm on the move this week. As you probably noticed, there's a different backdrop behind me. I'm in Adelaide, South Australia. Down here with one of my youngsters competing in the National Schools Cross Country Championships. So I've had a few distractions today, so that's why I'm bringing you a shorter video with everything in one place. Didn't want to leave you without coverage for the week, so hopefully this helps. Hopefully we get through some good stuff despite the my rearranged schedule. So without further ado, let's get into it. As always, it's a general commentary and doesn't take your personal situation into account. Okay, enough of that. Let's get into our first chart. So I've got the S&P 500 up on the screen. And last week, if you were watching, you'd know that we were talking about the potential for the market to come back and retest these moving averages. So this is the 50 and the 100-day moving average. Because that's quite a common event after a market turns up from after a sell-off, breaks above the moving averages. Gravity has a way of quite often bringing the market back for a retest, and that's what we've been seeing in the S&P 500 and across the equity markets generally. We're seeing that in the Nasdaq, in the Russell, the Dow. They're all doing the same. You see the same sort of pattern in the international markets as well, where we've got similar sort of price action. And the thing we want to do now, I think the key to this chart is that we want to see how this pullback unfolds, because we're going to see one of two things happen. We're either going to see the market start to set up for another push higher, or it's potentially going to build some sort of new sort of topping pattern and then start to roll over and head down towards this June low, towards the retest of the June low. Too early to say which way this is going to go as yet. So first thing to do, I think, is to put on the Fibonacci retracements, and I'm going to measure from this point here because I think this is a complete leg through there. There's always a bit of discretion about where you put the Fibonacci's. You know, we could use this point down here, for instance. Doesn't make a great deal of difference, but I'd prefer to use that. I think that looks like a better complete move to me. Looks like an impulsive 5 waves. Wave 1, 2, 3, 4, 5, if you like a bit of Elliott wave. So that's why you'd use that as a complete run. What we have when we do that is this initial move back has come right back to the top of the fibs, to the 38.2%. It's what ideally for the bulls, the sort of price action we'd want to see develop would be something like this, where it chops around a bit, comes back, maybe tests a bit lower, maybe gets down towards that 50% sort of mark, but then from there we start to get some positive upward momentum. That would be the best case scenario, I think, for the bulls. And what makes that such an attractive bullish scenario is it makes the next upward leg, if that's what we get, it makes it more sustainable by building a platform at this new higher level. We don't know whether that's going to happen, but that would be I think the nicest looking price action for a sustainable bullish move. The opposite to that would be if the market really does start to stall out and starts to break below these fibs, then we start looking at the bearish scenarios, which would involve a retest, potentially a break of this June low. But it really is too early to say. It's it could take a week, 2 weeks, could take several weeks just to see what happens in this area here. I think it's too early to be looking for a big rerun. That said, anything's possible. I've been talking about incrementally getting exposure to this market over the last 6 or so weeks. That remains the case. I don't want to be all in bullish at this stage because I still think there's a real risk that this is a bear market rally. So do a whole lot of other people, which makes me a little bit nervous about that scenario. So it's a case of lots of people looking at it being a bear market rally, but just keeping an open mind. I think keeping an open mind to bullish scenarios which could develop, because my worst case scenario in all this is that this does turn into a sustainable rally and being left on the sidelines watching it goes higher with no position. I'd call that a worst case scenario. So that's why I talk about incrementally getting exposure. If it's a bear market rally, we're not too wrong. We don't lose too much. We have exit strategies. If the market keeps rallying, well, then we've got positions. Now, I want to show you something really interesting, a study I've been looking at through the week, which supports the case that maybe this is actually more than a bear market rally. So let's jump to that now. I've got a prepared chart. So this is the S&P 500 on a weekly chart. Goes back to 2007, or actually 2006, but the important part's from 2007 onwards. And what I have down here, this is an indicator showing the number of S&P 500 stocks trading above their 50-day moving average. So people would often think, okay, when you get a lot of stocks above their moving average, 50-day moving average, well, that's a sign that the market's peaking and it's due for a fall. Not necessarily the case. What it can also demonstrate is that there's a lot of breadth in the market, that a rally is being supported by a lot of stocks. So it can actually be a bullish sign. Now, it gets up here, it gets above this blue line represents 90%. And you can see the market gets up here, reasonably frequently, might be a couple of times a year or thereabouts. I haven't marked them all in. The only ones I've marked are ones where the number of stocks hits 90% after a significant fall. So a fall of, say, 10-15% or more. These other cases, like this one here, for instance, occurred after a minor pullback. I'm not so much looking at that. I'm not looking at ones where the market's been rallying. I'm looking at the ones where it's hit this 90% marker after a significant fall. So this is the GFC. During the GFC, there were bear market rallies, plenty of big bear market rallies, 20 odd, maybe 30 odd %. But the number of stocks above their 50-day moving average never got to 90%. Those bear market rallies didn't have a huge amount of breadth to them. But then after the market bottom, we got the first big move up. Number of stocks above the 50-day moving average hit 90%, and that was a sign of market breadth and sign of a market recovery. Similar thing happened here after this sell-off in 2010. 90% market breadth led to a sustained recovery. Same thing here in 2011. Same thing over here in 2016. We had a period of weak prices. That was around, I think, about an 18% correction maybe. As soon as the number of stocks hit 90% above their 50-day moving average, it was a sign that the upward trend was resuming. Happened here again after the 2018 correction, which was quite a steep one. Happened here after the COVID crash, and look what's happening now. We're back up here. We've hit 90%. The number of stocks above their 50-day moving average hit 90% not long ago, a few days ago. So is this period here like this or like this or these other ones? Time will tell, but it is interesting. It's interesting to keep this in mind for all those thinking this is a bear market rally. Maybe it is, but there's some evidence to suggest that may not be the case. So that's why I say keep an open mind. I do slightly favour the bear market rally scenario myself, but I can see this sort of stuff happening. That's why I say incremental exposure to the market and be open to bullish possibilities. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Hey, Jason, thanks for the video. Just something really simple. Tells YouTube that people are watching, people are engaging. YouTube shows more people, and I keep making more videos, so that helps me heaps. So please do that. Also, hit that subscribe button if you haven't already done so, and come and visit me over at Motion Trader at my website, motiontrader.com.au. Lots of interesting stuff there that can help you with your trading and your investing. Now, just briefly, a couple of other things. Looking at actually I'll jump over to a different chart, jump over to the ASX 200. Look, same sort of scenario as the S&P 500. We don't need to stay on this too long. This big resistance band at around 7,100, 7,200. Market was stalling beneath there last week. Had its pull back to the moving averages. That's the bare minimum, I think, for consolidation. But I suspect that we're going to probably see another retest, probably see some more work. We will see what that work looks like, and then give us a better idea or whether it's going to be the market's going to be gearing up for a punch through this resistance, or whether this resistance is going to continue to cap the market. So we need more price action, but like the S&P 500, there is a bullish possibility there. The small ordinaries, ASX small ordinaries, same sort of thing. It hit this resistance band a week and a half ago at around 3,100. It's pulling back. Let's see how the market consolidates. If it consolidates constructively, then we start looking for the market to punch above there. But we need more information. As I keep saying, if you've been incrementally getting some exposure through this period here, now's a wait and see how it consolidates, punches through, add some more. If it starts to break down, maybe it's even cutting some back. So let's just wait and see how that goes. Now, I wanted to quickly look at uranium, because really interested in uranium through the week, in that we got quite a strong move with the announcement that Japan's looking to restart its nuclear reactors. Big bounce off this support zone at around $13. Look, too early to say whether this is the upward trend resuming, but all this through here, it all looks very much consolidative, very much corrective, and it looks to me like there's a big, potentially multi-year trend in the making. Just quickly looking at the weekly chart, why I like this, like you look back to 2007, big bear market, then a big grind sideways. Now we're getting the markets rounding higher, but these moves don't happen in these multi-year moves don't happen in months, and they don't happen in a straight line. They take time. They move up, then they ratchet along or grind along sideways. They consolidate, and then they move up for another leg. That's what I think is going to happen in uranium. The timing is always uncertain. This could just be a short burst higher, get some people excited, then it could just be back into the grind for many more months. But I do think the big upward move is there. I think it is. I think that's where the balance of probability is currently favoring. My preferred play is the Sporrit Uranium Miners ETF, ticker code URNM, listed on the New York Stock Exchange. Good way to get exposure to a portfolio of uranium stocks rather than picking one and you get the right one, you get the wrong one. This one almost guarantees that if uranium does well, you do well as also. And lastly, I'm just going to wrap up on a word on copper. I've been keeping an eye on the Global X Copper Miners ETF, US listed ETF, ticker code COPX. I like this because it seems to be getting some positive momentum starting to develop off this low back in July. And we're starting to see a series of higher highs and higher lows develop, with another break to a new high just last night. It's coming up to a resistance band around 33. Going to be interesting to watch it here. Look, the moving averages haven't turned higher. It's still below the 50-day moving average. This is the sort of one where you could dip a toe in the water to see whether this is developing, if you wanted to be a bit more aggressive in getting copper exposure. Alternatively, we wait and see whether this resistance breaks, because this could be the point to be adding copper. People adding up around here, it was all like, the big move was already in place. You had to wait for the big consolidation. The big consolidation's been happening over the last 12 or so months. Things are getting interesting again. So look, I'm going to leave it there for this week. Hopefully that's been interesting. Now night time in Adelaide, time for me to get up and do some other stuff. But look, thanks for joining me. Hope you found it interesting. I'll come back to my usual format next week. Look forward to joining you then. Until then, bye for now.